Right now, Opendoor Technologies, ticker OPN, is trading live at $8.77 per share, and it is having a very strong day, up 21 cents or 2.45% intraday. This move is happening on absolutely massive volume, with over 31 million shares already changing hands, putting it on pace to be one of its most active sessions in recent memory. The stock gapped up at the opening bell, starting the day around $8.08 and has already tested a high of $8.96 and a low of $7.85. This is the kind of volatility that many traders using platforms like Robinhood or SoFi Invest are drawn to, but it's the reason for the move that defies all expectation. The common belief, the narrative you've been hearing for the past week, is that Opendoor is in trouble. Their third-quarter earnings report, which dropped on November 6th, was by all headline measures a significant miss. They posted a loss of 12 cents per share when the street was bracing for a loss of only 7 or 8 cents. That's not a small miss, it's a substantial one. And the net loss widened to $90 million. In a normal market, for a high-growth, high-risk company, that kind of miss is a death sentence for the stock. The expectation was that the rally was over and the stock would collapse back to its lows. And yet, here we are, watching it trade near $9. This is the reality that so many are failing to grasp. The market is aggressively, and I mean aggressively, looking past the headline earnings per share miss. It is completely ignoring the widened net loss and is instead laser-focused on a different story, a story of a complete and total refounding of the company, as the new CEO Kaz Nejatian puts it. The expectation was that a 12-cent loss would crater the stock. The reality is that the market is buying into a narrative that Opendoor is no longer just a real estate company, it is now, in their words, a software and AI company. This isn't just a PR spin, it's a fundamental shift in strategy that the new leadership team is betting the entire farm on. And today's price action tells you that, for now, the market is betting with them. This is the kind of binary, narrative-driven trading we often see in names like Tesla stock. It's not about the last quarter, it's about the next 10 years. Let's establish the common ground, because it's important to understand what the bears are seeing. The common narrative is that Opendoor is a failed experiment, a cash-burning iBuyer that is entirely at the mercy of the 30-year mortgage rate. The model, they say, only works in a zero-interest rate environment where home prices only go up. The minute the market turned, Opendoor was caught holding billions in inventory it had overpaid for, leading to massive write-downs and staggering losses. The Q3 report seems to confirm this. Revenue was $915 million. That sounds like a lot, but it's a staggering drop from the $1.377 billion they did in the same quarter last year. They sold fewer homes, only 2,568 compared to over 3,600 last year. Even more frightening, they purchased far fewer homes, just 1,169, a massive drop from the 3,504 they bought in Q3 of 2024. This is the core of the bear case. The business is shrinking, the losses are growing, and the model is broken. Analysts largely agree, with many firms, including Keefe Bruyette, holding an underperform rating and a price target down at $2. That's not a typo, $2. So why is it at $8.77? This is where we challenge that common ground, because the reality is far more complex. The market isn't stupid, it's just reading a different chapter. The smart money and the frenzied retail money are placing their bets on the new management. The appointment of Kaz Nejatian from Shopify in September and the return of co-founders Keith Rabois and Eric Wu to the board was seen as a major coup. This is the Opendoor 2.0 story. Nejatian didn't just show up to the earnings call and apologize for the loss. He came out swinging. He declared the company is being refounded with software and AI at its core, promising to achieve break-even adjusted net income by the end of 2026. To back it up, he personally bought $1 million worth of open stock. That gets attention. But it wasn't just words. He provided a very specific, very tangible piece of data. He said that on his first day in September, the company was entering contracts to buy just 120 homes per week. By the last week of October, just 7 weeks later, that number had nearly doubled to 230 homes per week. This is the entire bull case in a nutshell. The market is betting that the headline miss on earnings was the final trailing data from the old Opendoor. It's betting that this new, aggressive, AI-driven Opendoor is already provably accelerating its acquisition engine. This acceleration is happening despite the challenging housing market. And speaking of that market, we've seen mortgage rates pull back from over 7% to around 6.26% today. Those Fed rate cuts in September and October are providing a tailwind. So the market is front-running a recovery. It's betting that if Opendoor can double its acquisition speed in a 6.5 to 7% rate environment, what can it do when rates are at 6% or eventually 5.5%? This is the expectation versus reality twist. The expectation was a story of failure. The reality is a story of a high-risk, high-reward turnaround. This is why you're seeing such a disconnect between analyst targets, which are based on past data, and the current stock price, which is based purely on future hope. It's not an NVIDIA stock story of proven earnings. It's a bet on a pivot. The recent stock movement has been a textbook example of this war between narratives. After the Q3 earnings, the stock tanked 9% in after-hours trading. That was the knee-jerk headline-reading reaction. But then, as investors and institutions read the transcript, as they digested the CEO's comments on acquisition speed and the AI refounding, the stock found a bottom and began to climb. And climb, and climb. The stock has been on an absolute tear for the last 3 months, surging over 200% from its August lows. This has attracted a massive retail following, the so-called Open Army, who champions the stock as a cult stock, not a meme stock. They're using Robinhood stock trading and SoFi active investing to pile in, creating extreme volatility. This is also creating a massive divergence in institutional holdings. Recent 13F filings, which show what the big funds are doing, paint a picture of total disagreement. Giants like T. Rowe Price and BlackRock slashed their positions, selling millions of shares. But at the same time, quant hedge funds like 2 Sigma and Cube Research either initiated a new position or massively increased their stake, buying millions of shares. Vanguard and Charles Schwab Investment Management also added to their positions. This is what a battleground stock looks like. The old guard is selling, and the quants and retail investors are buying. Let's take a step back for those who are new to this name. What does Opendoor actually do? At its core, it's an iBuyer. The business model is simple on paper. They give you a cash offer for your home online, sight unseen, based on their pricing algorithm. If you accept, they buy your home, do some light repairs, and then flip it back onto the market for a profit. They aim to make a small margin on the sale, plus charge a service fee, which is typically around 5%. The entire premise is to offer sellers certainty and convenience, saving them the hassle of listings, showings, and uncertain closing dates. This is a massive multi-trillion-dollar industry they're trying to disrupt, and their main competitors are OfferPad and historically Zillow and Redfin, although those two have largely exited the direct iBuying space. The problem, as we saw, is that this model is incredibly capital-intensive. You have to buy the homes, which costs billions, and it's incredibly sensitive to home price fluctuations. If you buy a home and the market drops 5% before you can sell it, you've just wiped out your entire profit margin and then some. This is what happened in 2023 and 2024, and it nearly broke the company. The new AI strategy is essentially a promise to be much better at pricing homes, to buy the right homes at the right price, and to sell them faster, minimizing risk. So this brings us to the future outlook. This is where it gets really interesting. The company is not just resting on its AI laurels. They just announced a special dividend of warrants to be distributed on November 18th. This is a very complex move. For every 30 shares you own, you'll get 3 different warrants with exercise prices, the price at which you can buy a new share at $9, $13, and $17. This is a way to incentivize shareholders to stick around and, if the stock does well, to raise more capital for the company down the line without diluting everyone immediately. It's a bet-on-us move. The $9 warrant is already nearly in the money. This adds another layer of financial engineering to an already volatile stock. So what are the scenarios? The bull case is clear. The new CEO is the real deal. The AI-driven pricing model works. The recent doubling of acquisition velocity is just the beginning. As mortgage rates continue to ease, the housing market thaws out, and Opendoor uses its superior tech to buy and sell thousands of homes.